Welcome back to the Ignite podcast. Today, we're delighted to have Abby Lyall with us. Abby, would love to get an intro from you and get your whole story for the audience.
Absolutely. Thank you so much for having me, Brian. It's great to be here on the Ignite podcast. A little bit about me. I'm an investor at Tribeca Venture Partners. I've been a VC since 2016, actually, which feels like a really long time now. And a little bit about my story. I guess I'm originally from Ohio. I moved to New York in 2014 to go to Stern, which is the business school at NYU. I studied finance and computer science there. I thought that I was going to do the conventional investment banking thing because that's what everyone in undergraduate business school
Oh
is
yeah.
told they're going to do. And accidentally fell into starting a company while I was there. It was a total fluke. A friend and I just decided to enter this business plan pitch competition to have something to put on our resume for finance interviews, and we ended up winning. The contest was called the Stern Social Impact Business Competition. We ended up winning a $20,000 grant to go start the business. So it was either go try this, try to build this thing that we put together in a pitch deck the night before in his dorm room, or give back the $20,000, which we didn't want to do. So we ended up starting. We ended up starting.
Yeah, we'll take the 20K. Yeah, thanks.
Exactly. Yeah. That was all the incentive we needed to give entrepreneurship a try, right? So we started the company. I was 19 years old. Totally wasn't what I was expecting to be doing. Ran the company for 2 years while also still in school at Stern. It was a digital platform for student volunteering, so helping students find volunteer opportunities that fit with their skills and interests, and helping them track their hours and measure their impact in ways outside of just clocking hours to sign off for a club or resume or something like that. Great idea, not great execution. I mean, I was not a great CEO at 19. My partner and I learned a lot the hard way, trial by fire, by doing. We were trying to sell into K through 12 education, which is one of the toughest and most difficult sales cycles anyway. Is really tough when you're a sophomore in college and have no idea what you're doing with your life. But it was a fantastic learning experience. I learned a ton. It really showed me that what I wanted to do was, entrepreneurship and innovation, and that was the path I wanted to follow instead of more the conventional finance background. So I started working in VC. Actually, I was a junior in college. A friend of mine, someone that I knew from the entrepreneurship lab at NYU, his name was Brandon Meyer. He's a partner at a fund called Quake Capital, which at the time was just starting out. I was the second employee. They're an accelerator fund, investing industry agnostic pre-seed stage companies. I joined as a very early employee, helped them build out their accelerator program from scratch. I ran 5 cohorts for them, worked with 75 pre-seed stage companies across a wide variety of industries, helped them grow. We started in New York, helped them expand out to LA and Austin, open new offices. And then in 2019, I left that role and kind of rinse and repeat, went and did the same thing again at a fund called Big Idea Ventures, which at this point was focused on plant-based food and alternative protein. So similar role. I was once again a really early employee, building out a fund and accelerator program from scratch, working with early stage companies, but this time sector specific in that narrow segment of vegan food. So investing in both CPG brands, but also in the technologies, underlying technologies behind cultivated meat, microbial fermentation, things like that.
Wow.
I did that I was in a couple different roles there. I was in the accelerator role at first. Then I moved into a role that was sort of special projects focused on deals outside of the accelerator, some other projects we were working on, like a university IP commercialization initiative. We were building a food manufacturing plant for a while. That was fun.
Oh, wow.
Doing some fundraising related activities also. And at the end of the day, I really felt like I was missing that true investor role at a venture capital fund. I'd sort of had a number of roles that were sort of half that, half other stuff.
More operating, working with the founders and the members of the accelerator.
love operating. I think, at my core, I really am an operator at heart. But I wanted to get that proper investing skill set and proper
Yeah.
investing training and work for a fund that had a brand and a track record in that regard, and work with experienced managers and learn from them.
Oh,
And I found that at Tribeca. So I joined the team at TVP almost 2 years ago now. It was January of 2022. And I'm on our investment team. So I'm focused on sourcing and diligencing opportunities for both of our funds. We have an early stage fund that's primarily Series A lead, and we also have a growth fund, which is focused on Series B through pre-IPO opportunities. We're sector agnostic within tech, so anything with a technology component we'll look at. We have a strong focus on New York-based tech companies. So 80% of our portfolio has at least one founder or C-suite team member based in and around the New York area.
mm,
So we've got a strong conviction and deep ties in the New York tech ecosystem. So yeah, that's my long and winding journey.
that's amazing. Yeah, thanks for that. Incredible journey, incredible story. I'd love to. There's so many things to unpack there. I'd love to start with some of the lessons that you took away from starting your venture, winning that 20K prize, and how that informed how you advise startups. Let's start there.
Yeah, I mean, the biggest thing that I learned through that experience was just how much I didn't know, funny enough. And the thing that I've gotten from working with a lot of CEOs and just talking to lots and lots of CEOs over, the course of the last several jobs that I've had, I feel like the best CEOs are the ones that are the quickest to admit the stuff that they don't know and when they don't know
Hmm.
something. And really, like, the mark of a great CEO or a great business leader of any type is sort of knowing when something is not your skill set and is not your area of expertise, and then being able to put the right people around you where it is their skill set, it is their expertise. And I think that
Mm,
the best businesses are really built that way. I've seen a lot of companies that I've worked with unfortunately fall into the trap of, like, trying to do everything themselves or trying to be the authority about on everything. And that's just not possible. And I think that's something that at Tribeca we try to do with companies that we invest in as well. We typically take a board seat, so we're actively involved
right.
in board meetings and advising that way. And I think just like the really great founders that I've worked with have built out a great board, built out a great advisory board, built out a great cap table of folks that bring stuff to the table that they don't.
Yeah.
And I think are successful largely for that reason. So yeah, the biggest learning, the biggest learning from my job experience was that I was, 19, 20 years old and had never even really had a real job before
Oh, yeah.
at a company, let alone the skill set to run one. So I
Right.
sort of went out looking for some of that experience before I tried it again.
Yeah, that's amazing. How did your experiences running an accelerator and running 5 cohorts inform how you make investment decisions and what kind of companies you invest in?
Yeah, I mean, there's a number of different strategies, right? There's lots of different investment strategies of investment within VC, right? So I think the accelerator style of investing is very much, a distributed style of investing where you make lots of investments. You put the companies through the program where you provide some value add, but sort of the assumption is that most of them are not going to make it, right? Like
Mm,
these companies are very, very early stage. The checks we're writing were very small. They were 125K. So, pre-seed stage investments, very, very early stage, very small checks. Very,
Pre-revenue in
you know,
most cases, and even pre-product in
yes,
some cases.
sometimes they'd have some revenue. Most of them had a product of some sort, and some of them had some revenue, but definitely pre-product market fit.
Yeah.
Like, definitely still, figuring out. Many pivots were yet to come. Still, definitely still figuring out, like, where exactly that product fit in sort of the customer journey and what pain point they were exactly solving in a lot of cases. And so that style of investing, now being at a firm like Tribeca, where we sit a bit later stage, Series A is sort of the bread and butter. And then, we also have the growth fund as well. It's a much different approach. So, it's a much more concentrated portfolio. We do 4 or 5 deals a year. Typically, wow. We're very hands-on post-investment. So not just a 3-month program where, we're giving companies a bunch of resources and then beyond that, checking in occasionally. Yeah. It's dedicated support through the life cycle of the investment, which in some cases in our portfolio is, 7 years, 10 years, or even more. We still have companies that we invested in 2012, 2013 that we're still supporting. So I think, in all stages of investment, in venture, there's a high failure rate, right? Yeah. Even at Series A, Series B, that's just sort of the nature of the game. But I think being able to see that contrast from the accelerator style of investing, where it's very much diversification is key, spread it far and wide, and, knowing that at this stage, most investments are going to fail. And then the few that really hit it out of the park will be the ones that will make your success, versus, that's still being true to some extent at Series A as well. But really doing much deeper diligence, having much higher conviction in the market, and the positioning of the product, and having that really high conviction, as well as providing a lot of hands-on support post has been a good exposure for me to see both of those different styles of thinking about investing.
Right. Yeah, because the pre-seed is very much almost like a spray and pray. Honestly, it's 75, 100 portfolio companies, and you're hoping one of those goes 100, 200x, and it returns the entire fund. Right. That's kind of the pre-seed strategy style.
It's still true at the A that those 1 or 2 top performers are providing most of your alpha for the fund. But just the way we think about making investments, it's like there's much less of a tolerance for, when you're leading a deal, which we usually do, and you're pricing it, and you're going to be sitting on their board for the next however many some odd years.
It's a different kind of commitment. Yeah,
exactly. There's much less tolerance for like a flyer, than there is at the pre-seed.
So the fund, the Series A fund has how many will have how many investments when it's fully deployed?
Probably around 20 to 25.
Okay. Yeah, so that's very concentrated. What about the growth fund?
Yeah. The growth fund, we're targeting around 15. So even more concentrated.
Interesting. And what's the typical check size for an A? What do you guys look, there's been shifting definitions now of Series A, especially over the last 5 years. What do you guys look for to make an investment? What is the kind of the criteria as something comes into your inbox? Is this A material or not? Should we even take the call? Like, what do you guys look for?
Yeah, absolutely. And you're right. You bring up a really great point that there's been a ton of shifts, especially this past year, in sort of what constitutes an A. Typical check size for us for an A is usually between 3 and 8 million. So usually we're leading around, we'll typically be lead or co-lead. Usually we're taking around half or so of that. So usually we're leading rounds in the 6 to 16 million range. We try to do price rounds only. There's seed extensions and safe and note rounds have been very popular this year. We're not doing a whole lot of those. We are doing some A extensions. That's been we've looked at a couple of those types of deals, just to have the opportunity to get some companies that are slightly more mature and a little bit more de-risked into the portfolio. Yeah. But a lot of those sort of $1.5, $2 million notes, seed twos or notes, we're not really doing as much, even though they're very popular in the market right now. Yeah. So typically what we look for, we like to see at least $1 million or so in ARR. That's always been our threshold. I think, in this somewhat contractionary environment, it's nice to see a little bit more. Yeah. But I think what we're mostly looking for is a round size and valuation that's reflective of that ARR metric. So, revenue multiple is very important. I think at the peak of the 2021, early 2022 hype cycle, I was seeing companies raise it
100x,
like 100x multiples on the revenue.
Oh, you got $1 million of ARR? How about 100 million valuation? Yeah, crazy.
Yeah. And that's
Yeah.
just not, I think for an enterprise software company, which is typically what we do a lot of, somewhere in the
Yeah.
8 to 12x range is typical at A. And that's, it's funny because like we've always thought that way. Like our firm never really stopped thinking that way.
Yeah.
We were not one of the firms that was plunging into crazy hype-filled rounds at insane valuations at the top of the market in 2021, which has left us really well positioned.
Yeah. So that's
But
interesting. So you're looking for $1 million of ARR, and you'd prefer to write, call it a $3 million check on a 10 million valuation. Is that kind of the math, or?
yeah, I mean, we'd like to see more than $1 million in ARR
Yeah. So
if
what
we
would you
can
do?
get it.
What would it look like if it's an enterprise software company? I'm just giving you for my own
Yeah.
edification or for the audience's
We
edification.
we typically take around 10%
Okay.
of a company. So if you have $1 million in ARR, and let's say we think a fair pre-money valuation for that is 10 million, then you probably shouldn't be raising 6, right? Because then you're giving up a lot more of your company. So
Yeah.
typically at A, we suggest that you give up around 20% of the company, and
Right.
the lead usually takes half of that, which is around 10.
Okay, got it. All right, so let's imagine a company just quadrupled their revenue from 500K to 2 million, and it's an exciting enterprise company. What are the typical deal terms that would occur in that round?
There's no such thing, unfortunately.
Yeah, I know.
I wish if I could sit here and give you a
Yeah.
playbook for exactly what terms a company is going to
Yep.
get at Series
Yep.
A. I wish I were able to do that, because it would
Yeah, pull out
demystify
the
the
Series A
industry a
calculator
lot.
for me. Yeah.
Yeah.
Because it's
Unfortunately,
fundamentally it's a negotiation. You just don't know, right? Yeah.
Right, exactly. So fundamentally it's a negotiation. I mean, there certainly still are companies that are, raising at significantly higher valuations than what we think
Yeah.
makes sense. Because there's still funds out there that are willing to do that,
Right.
obviously. So I think it depends on the market a lot
Yeah.
as well, right? So like there's certain sectors like AI, for example, that are, which is so funny that that's a sector. We can dig into that later. We've been investing in AI companies since 2012 or 2013. And so it's just so funny that this whole generative AI boom has just gotten everyone with any sort of machine learning algorithm slapping AI in their company name for a premium. But depending on the sector that you're in, then you might be able to command a higher valuation premium based on that as well. There's lots of other factors, like companies might have certain contracts or deals in their pipeline that are about to close and that haven't closed yet, and then you might do the valuation based on a forward-looking revenue multiple.
Right.
That's also common.
What are the typical valuations you are seeing in A? What's kind of the range? The middle 80%.
Middle 80%. So for a $10 million A, which I'd say is probably typical size, typically we see companies giving up around 20% of that round. So that would put them at a 40 million pre, 50 million post. So
Yeah. Okay. Yeah. I think that's what I'm seeing. I'm seeing as low as 30 and as high as 100. I mean, if it's AI, like you said. Yeah. But yeah, typically I'd say 30 to 50 is kind of that middle 80%, kind of the typical range.
Sure.
Yeah.
Yeah. And I think there's a lot, there's also like what constitutes, the reason I was hesitating is because like what constitutes an A can change so much, right? Like I'm looking at one deal right now that's a $6 million round. And they're a Series A, they're calling it a Series A. And that's sort of a typical deal for us, maybe on the lower end.
Yeah.
And then I also see companies that are raising, $20 to $25 million rounds and calling that an A. But then I'm also talking to a company that's going out and doing their B in January, and that's going to be a $20 million round. So, you ask, what does a typical Series A valuation look like, or round look like? And it's just a really difficult question to answer, because A is sort of this weird category where it's like the bottom end bleeds into a seed and then the top end bleeds into B.
Right.
So it's just an odd, it's an odd thing. It's an odd thing to make generalizations about, for sure.
Yeah. It is. What are some other kind of check boxes you guys look for to take that first call on a potential A?
The most important thing for us is a really, really big market. So back to what I was saying before on the, couple of top performers really returning the whole fund. It's super important for us that we see that pathway to an exit that's $1 billion or more. Obviously, not every company is going to get there, but there are lots and lots of great businesses out there that have the potential to be really phenomenal, super profitable, $30 to $40 million businesses that can make a lot of money for their founders and could make a lot of money for angel investors or other types of investors as well.
Yeah, kind of the pre-seed guys, guys and gals.
Sure, but for a venture fund where we have certain benchmarks and return thresholds that we have to hit for our LPs, we really need to be able to see that pathway to a multiple, an exit in the multiple hundreds of millions or billions. Again, not every company is going to get there. That's why it's important, right? Because you need those few that are going to get there to make up for all the ones that either don't or that do a smaller exit at 1 to 2x. So that's another really important thing we look for. Another big consideration for us is gross margins. So we're sector agnostic, but we typically end up leaning heavily towards enterprise SaaS and marketplace companies. Mostly because we like to see gross margins 60% or above. Obviously, same with the ARR. That's very much a bottom threshold, right? Like more
60 sounds low for a software company.
Most of the pure enterprise SaaS companies we see have gross margins in the 80s or sometimes
or even 90s.
Yes. So again, like absolute bottom of the barrel threshold at 60, typically we're seeing more like 70 or 80. And so, while we have invested in hardware companies on occasion, we've done a few, tech-enabled services types of businesses. We have done some deals like that, but it's a lot easier to get to that gross margin profile that we like to see with more of a software component.
Love that. Let's unpack the market thing because that's along with the kind of the timing thing or the gross margin thing, the business model thing. I think that's really important. How do you look at the market and say, okay, you got this company with $1 million or $2 million of ARR. It's growing fast, amazing team, obviously, right? And so you're kind of looking at it, and how do you go? What does that market need to look like?
Yeah, so that is a really loaded question because a lot of I've seen so many, every deck, and I see a lot of decks. Every deck has that market sizing slide, and every single one has like a monstrous TAM.
It's huge. It's $1 trillion.
Yeah, $9 trillion. Yeah. And so it's tough when you're the one that's doing the diligence and doing the digging into the market, to get to conviction on an investment. It's tough to know, like, where are those numbers coming from and are they legit, right? Because you oftentimes have to compare 4 or 5 different external sources to kind of get to a number that's meaningful. But it's also like, it's not just, I think the biggest thing to highlight with that is that it's not just about how big that market is overall, but it's also like how much of that market that what you're doing in that market could capture. So for example, if you're like a construction SaaS platform and I'm making up these numbers, but you put a slide in your deck that says the US construction market is $2 trillion. But most of that spend is obviously on lumber and pipes and labor and things like that.
You're not quite being honest, right? Like, how much do they actually spend on software? Yeah.
Right. So I think it's important, obviously to give, to kind of break down. That's why it's nice to see a TAM and then also a SAM and a SOM and like other, like multiple different numbers representing the market. It's like, all right, this is a huge market, but this is how much of that they're actually spending on software. This is how much of that software spend in this industry that we realistically think we can capture. then based on that, we can get to an idea of like, all right, as a mature company, what do we think the annual revenue of this company could be? And then we can apply a reasonable multiple to get to, what we think a good exit valuation could be.
So let's break down the TAM, SAM, SOM thing for the audience that didn't go to Stern.
Sorry. So TAM stands for total addressable market. So that basically just means like the entire market that you're operating in.
Yeah.
So, like if you're selling shoes, then if you have a shoe company, then the TAM is all the shoes that are sold in the US. Let's say it's a US shoe company. So your TAM is every single shoe sold in the entire United States. Then the SAM is the serviceable available market. So that's basically like the amount of that market that is available to you. So if your shoe company is a sneaker company, then your SAM is a subset of that broader TAM of the US shoe market. It's the US sneaker market, which is like a smaller subset. And then SOM is serviceable obtainable market. So that's essentially like what percent of that do you think you can get? So if you think that your sneakers are so cool that you can realistically obtain 10% of the total US sneaker market, then your SOM is a subset of that US sneaker market, and it's 10% of that number.
Got it. And then walk us through the multiple. How do you find a reasonable multiple, and what does that look like?
So for a company, I mean, if we're projecting out a valuation at exit, we would typically look at public comps or recently acquired private exits in that category, which sometimes the data is available on those and sometimes they're not.
Yeah.
But the public data is always available. And it's not perfect, but it gives you sort of a sense of like what comparable companies in that industry are exiting at. So for example, if you were a data analytics company, if we had a data analytics company and we were thinking about, all right, let's say we exit this data analytics company in 5 years, what's that multiple going to be on the revenue at exit? You would take, the 5 seemingly most similar publicly traded data analytics companies. You would look at what they're trading at, what their market cap is, versus what their annual revenue is. And then, from there you can get a multiple of like their valuation. Enterprise value is basically a valuation of a public company.
Right.
And it's comparable. And then, as opposed to like what their, trailing 12 months revenue is or whatever that metric is. And then you could also, if you're able to find the information, you could also look at acquisitions or other types of exits of, PE buyouts or other types of exits of private companies that were in that same sector. But the key is like in that same industry.
Yeah.
Right. So like you want to make sure, for SaaS companies especially, right? Like you can't really compare apples to apples. If you're like a construction SaaS company, again, like you couldn't really compare that to like the data analytics company. You would want to use comps that are doing something similar to what you're doing.
Love that. So you're looking at this company, you're going to invest at say a 50 cap, post money, and you want to believe that it can be, is it $1 billion? Is it $2 billion? Is it 20x? Is it 40x? Like, what do you want to believe to write that check?
I think, anything in a $1 billion valuation is a good proxy.
Yeah.
Again, it depends on the deal, right? It depends on the deal. It depends on the sector.
Right.
But, let's say and depending on where they're at traction wise, you might underwrite to, a slightly lower valuation at exit or a slightly higher. But I'd say $1 billion is a good proxy.
So you're hoping that 20 or 30x becomes a reality, and then what kind of revenue typically is that for your average enterprise software company to get that $1 billion valuation?
Well, if you're saying a 10x multiple, then that would give you $100 million in revenue.
There's that number again. It's the magical 100 million revenue number.
Right.
It always comes back to that number. Yeah.
I would say typically if you can project, because obviously there's enterprise software companies that are trading at higher multiples than that, right? And also lower. Yeah. So I'd say if you can underwrite to $100 million in revenue at exit, you're doing pretty good.
Yeah. And then I guess digging into the the market sizing question, you're looking at the SOM in this case, right? And or let's back up to the SAM. So the SAM, call it's $1 billion. You're like, okay, that's a big market. It's a you can go, the available market to you is about $1 billion. Then what you're basically saying is the SOM has to be 100 million, which is 10%. I have to believe you can go capture 10% of this $1 billion market for me to invest. Is that
Yeah,
roughly the
and it
calculation?
depends.
Yeah.
Yeah, it depends. The 10% is just like a random number, right? So like
Right.
for some
Yeah. Yeah.
industries, it could be less.
Yeah.
And then for other industries, it could be a lot more, right? And then that's where the competitive landscape comes in, because you have to look at what other companies that are out there. So like if you're operating in a very crowded market with a lot of entrenched incumbents or a lot of other venture-backed startups that are doing something really similar, then you're like, all right, 10% is probably unrealistic. Probably we
Yeah.
can realistically only get 2 to 3% of this. So it's extra important that the SOM is larger, or the SAM is the TAM numbers are much larger. Versus if you're in a new category that you're essentially creating.
Yeah. It's
Where,
Uber, and you've never seen Uber before. Well, that's a consumer company,
right.
but you're like, what's the market for Uber? And I think a lot of people passed on it because they looked at the taxi market, and they're like, that's not big enough.
Right. And so, right.
Yeah.
If you're right, not realizing how lazy people were, where, the taxi market would expand
Yeah.
significantly if we could call them using our
Right.
smartphone.
Right.
Or like social media is another really good example, right? Like that was like a category that just like didn't exist at all.
Right.
So, the TAM was sort of zero. So, or like another one, for example, like we have a quantum computing company in our portfolio. Which was one of those companies where we're sort of like, all right, this is a market that's essentially zero right now, right? Because the
TAM is
really
zero. There is practically no market. Yeah.
Right. But it has the potential to potentially be, a massive world changing market in the future. So we'll make a bet in that space and sort of have that be one company in our portfolio where, if it does really well, it will definitely return our fund. But basically we have to see the fund returning potential in some way, right? And that's why a lot of these math around what's typical questions,
right,
unfortunately, don't apply as well to venture as you'd hope they would. Right. Because you give people a formula like this, like, oh, your TAM has to be X, so your SAM can be X and your SOM can be Y. So then you can have a multiple of Q. And so then a founder is going to hear that and they're going to be like, okay, I just do X, Y, and Q. And then they're going to see, and then they're going to see 30 other deals get funded that week that look nothing like X, Y, and Q. And they're going to be like, those guys were full of it. And that's unfortunately how the venture industry works in a lot of instances.
Right. That's funny. It's supply and demand, and you talked about the AI stuff getting bid up, and what back to this age-old question in venture of art versus science for the Series A, and as an investor who has done the pre-seed thing, what percentage is it art and science at the A?
I think it's mostly people. So I don't know if that would fall
under
into
the art side,
category or the science category. I think business in general, right, is really largely people, but venture in particular, and definitely the earlier in venture you go, the more that's true. But A still is very much around people. And not just the founding team you're investing in, obviously that's a huge component, but also how you're growing and expanding that team and putting other people around those people becomes really big at the A in a way that it isn't at pre-seed and seed. So at A is typically when you start really filling out the team with a lot of like really key inflection point hires. In particular, on the sales side, on the technology side, on the market side, a marketing side, like a lot of big processes like leading go-to-market strategy, for example, start to roll off of the founders and on to other key C-suite, experienced C-suite executives at A, some of whom depending on who the founders are and what their background is, might be more experienced than the founders and the CEOs in those areas. So I think it's not just about like pre-seed and seed. It's pretty much like all exclusively about believing in the team, because like the
founders.
pivot, the idea, the founders, like the pivot, the idea, the company, the product's going to change a lot. Like your product in pre-seed is going to look nothing like it does today. Your early traction, early customers probably aren't your ICP. You'll move away from them. You'll learn that later on. Your business model will probably pivot multiple times. So it's really about, believing in those people. At the A, it's also about believing in those people, but it's also about who are those next key hires? How are you building out these other parts of your organization with this cash that you get at A? It's really an inflection point where that flywheel of go to market starts to spin. And then it's also about, like the other people that you have around the table. So like building a great cap table, building a great board, making sure you have the right advisors, partners. Customers are really important too, like especially for an enterprise company. Who are those sort of core ICP customers that are going to advocate for you, that you can learn from, or in some cases can land and expand within. So not that there isn't a quantitative component, because there is, but
break that down. What's the quantitative versus qualitative for the team at the A? I would love to kind of know what you guys kind of look at, and how you assess that team to be an excellent team versus maybe just a good team versus, hey, we should pass. I don't think this is a very good team.
Yeah, I don't know about quantitative for the team so much. I think when I said quantitative, I was more thinking about like financial projections and modeling and stuff like that. I mean, there certainly are like certain attributes we look for. I think the most important one being some level of experience in that industry. So like, why is this founding team the most qualified team to do this, is essentially what we're asking, right? Like, so it's not about, at least for us, for some venture firms, it seems like it is, but at least for us, it's not necessarily about like the Stanford or Harvard pedigree. Obviously you learn some things at those places, you get a great network from going to those places. It's not like they're bad. But it's more about like, are you the most qualified team to be in doing what you're doing? So, back to the construction tech company. I keep using that example because I think it's just like it's a great example of like a legacy industry that's like being disrupted by technology that in many ways is like leapfrogging existing solutions, which is like an area, a thesis we have and an area that's really exciting for us. But like if you're a construction tech company, for example, like, and you're some like Stanford guy, like that's the wrong person to have in that seat in a lot of instances, right?
Because did you grow up on job sites? Did you like, go build buildings?
Like, right. Like if you're going to call this guy who's your customer and try to get him to buy what you're selling, he's going to, think you're a prick and hang up on you, you want to get like the profile.
I went to Harvard and I have a new software system for you. It's like, what?
For you, with zero understanding of the problem, right? So you want to get a team that has like a great understanding of the problem and the industry that they're building in. If they were a customer or, experienced the problem firsthand, that's even better. And then some sort of track record of success, right? Like we love investing in founders that are, second, third, fourth time founders. Have started a company in the past, especially if they exited or, have some sort of learnings from that they can bring to the table, then that's great. And then a good balance of skill sets across the team is important too. So ideally you want, someone who is great at sales and business development, someone who's great at sort of the technology or product side. You don't want, 2 or 3 people that all are kind of trying to do the same job.
It's really interesting what you're describing, and it's something that I've been formulating with my thesis and stuff. It's almost like this Goldilocks zone of things, right? One founder not as good as 2 founders, but maybe too many founders also bad, right? You have, let's say you have 3 founders, they all do engineering, not as good as maybe one does business and marketing and sales, and one does engineering and one does design, and so there's like. In venture, there's no hard and fast rules, right? It could be any of the above, but it's kind of like the combination of all these elements, right, that makes the decision.
There are no hard and fast. Like, that is the perfect. If you could distill this conversation down into like one sentence, like if I was, instead of having an hour-long podcast as an interview, if I could just say one sentence, it would be that there are no hard and fast rules.
That'll
Every
be the title
hard
of the
and fast,
podcast.
totally, every hard and fast rule that we claim to
Yeah.
have as a firm with regards to our investment process, what types of companies we do or do not invest in, so on and so forth, has been broken at least once. Every single one.
Yeah, another phrase that I love is strong opinions weakly held.
I love that. I love that phrase. Yeah.
It's like for me, out of 110 portfolio companies, I only have 4 shutdowns, right? They're all consumer, they're all solo founders. And I'm like, maybe I shouldn't do solo founder consumer companies, but who knows? Maybe I run into a really great one. So it's like a strong opinion weakly held, right?
Weekly held. Yeah, that's impressive, by the way. 100 portfolio companies and only 4 shut down.
Yeah, I mean, I find with B2B SaaS, once they have revenue and they're growing and they have a good team, it's really hard for them to shut down, because people need their software. So what ends up happening is they get acquired for maybe not the greatest exit or
sure. An acqui-hire of some sort, because you've got people on your team that can code and build software. Then someone's going to want to buy it, even if it's not a great outcome for the investors, just for the team.
Yeah, and so it ends up being like you don't get these wind downs that you get with consumer. I think with consumer you're just like, I can't monetize, I can't grow, this is hard. Oh, Google just added this as a feature. Whereas enterprise software, I think it's the best. B2B SaaS, you literally got somebody to pay a monthly fee or an annual fee to solve that problem for them. Thanks for that. Now I need to use it every single day to like solve this problem.
Yep, that's why it's a great sector.
Yeah. What else do you guys look at when you're considering whether or not to either take the call or invest in a Series A?
Yeah, I think, the market that they're in is really important, not just in terms of size, but also in terms of trends and other players. So like we spend a lot of time looking at competitive landscape, what other solutions are out there, whether it's like venture-backed tech startups or incumbent solutions. I always ask, a question I always ask founders in the first meeting is like, what are you replacing? Like, what is the status quo that your customer is using? Even like a lot of times that answer is like Excel or landline phone, pen and paper. It doesn't have to be a sophisticated answer, but like if there's a problem, people are solving it some way, even if it's a bad way. So
a lot of times it's spreadsheets, right? Yeah, they're doing this in spreadsheets and they're linking the spreadsheets and they got, Visual Basic, code running on those spreadsheets and.
Totally. So yeah, competitive landscape is really important. And then recently one that's been coming up a lot, back to sort of the earlier discussion of the valuations and sort of the boom and bust cycles we're going through in venture right now. It's sort of like capital efficiency, burn, path to profitability. A big thing that I like to look at is how much money has the company raised in the past and like what have they done with that, right? So
I like that
if you
one.
have a 2 million ARR company, right?
How much money did you burn to get 2 million of ARR?
Exactly.
So that's called the burn multiple for the audience. Yes. What is a good burn multiple? And what's a bad one?
Yeah, it depends a lot on what they're doing. I think for typically if they've raised more than 20 million already, it's almost a definite pass.
Yeah, so that's a 1 to 10 ratio. So you burn 20 to make 2.
Yeah, if you had 2 million in ARR and you had 20, that would be a very that's a very bad one.
Yeah.
Yeah, that would be a very bad one.
I've run into some of those, by the way, where they've burned 15, 16, and they have like 400K of ARR. I'm like, oh gosh, you should just
I've run into
shut this down.
More of those than you'd think. Like way more of those than you'd think that are out there. So yeah, definitely a 20 million or above, I would say, is almost a pass just for that reason alone, without even digging into what they're doing. If they have burned 10 or more, I'd say that's still kind of although it might be worth like digging into why that is, but I'd say that's still, considered a negative one. And if they're mostly bootstrapped, obviously that's the golden one is zero, of course.
Yeah. Oh, we've completely
Uh,
bootstrapped this, and I've run into those actually too. What's exciting about
sure,
AI
yeah.
is it's software's eating the world, AI is eating software. I'm running into companies that haven't even raised money and they have 1 million of ARR, and they're automating everything with AI, and it's exciting. That's like, wow, that's
Sure,
really impressive.
yeah, absolutely. And recently, I've been running into a lot of companies. I think that whether their investors advise them to do this or not, but they're paring down their spend to get to cash flow break even, so then they can raise when the time is right and when makes sense for them, instead of when they're going to run out of money, which I think is super smart, because um, most the worst time to go out and raise a round is when you're running out of money. So like, we always want to know what the company's runway is. A good one before you ask is 6 to 12 months typically. If you're getting under 6 months of runway, you should kick off your raise for sure.
Oh yeah.
Because you don't, especially in this market when raises are taking a lot longer to do, you do not want to be in a raise process with only 2 or 3 months of runway left, because also VCs will see that you're in that weak position, and then there'll be a lot. The valuation that they'll be offering you will not follow the X, Y, and Q formula.
Yeah. What about what are some other red flags? I love this like conversation, and the reason I'm diving in so deep, I think you're the first Series A investor I've had on the podcast, and so I'm just picking your brain a lot, because I'm a pre-seed to seed investor, and I love to learn what exactly you're looking for. What are some other things that you guys look for?
Covered team, we covered market, we
Burn
covered
multiple.
competitive landscape,
Yep.
burn, runway, cash efficiency, approaching profitability. Profitability is not a requirement, but it's we like to see. It's nice if the company shows us that they can get there. Another thing we really dig into a lot is go-to-market strategy and sales motion. So that's something that at the A, I think, becomes important in a way that it's not.
How do you acquire customers?
Yeah, because it's seed, like, again, like, you're still looking for that product.
Sometimes it's founder-led sales at that point. When I'm investing, they're just out there.
It's almost entirely, it's almost entirely founder-led sales at seed, in my experience. And a lot of times that early sales motion is not what your sales motion is going to look like at scale. And your early customer might not even be your customer that you have at scale, right? So like, I worked with a number of companies where, their ICP that they had at seed or at Series A, right when we invested, was one very particular type of customer. And then when they got into it more and started building out an actual scalable, repeatable sales motion, they started to realize that, either maybe they need 2 different strategies for go-to-market for 2 different types of customers, or maybe their ICP is actually, something else, which stands for ideal customer profile for non-business school people. But I think that's super important, is that, what's your go-to-market strategy now? How do you anticipate that changing at A? Because it often will, because you're going to have more money, so you're going to be able to build your team.
Turn it up a bit.
Generally, building out a sales org is one of the primary reasons companies are raising Series A in the first place. And knowing that the company has that figured out. So a lot of times for us, and one of the things that makes like the ARR piece so tricky, and why we kind of have that like low floor of 1 million, is that a company with 1 million in ARR, but that's like shown clear product market fit with a great go-to-market sales motion, short sales cycles, which is super important. You do not want to be stuck in an industry that has like 12 to 18 month enterprise, multi-stakeholder buy-in enterprise sales motion. That's a disaster. And, being able to show that they have this scalable, repeatable process where more fuel on the fire will sort of lead to starting that flywheel of exponential growth. That's better than a company that has 5 million in ARR, but it's lumpy, or it's from just 1 or 2 customers, and they haven't really shown that it's repeatable in a way that demonstrates that product market.
Yeah, you got lucky. You got 1 big customer. Congratulations. That's 80% of your revenue. But how are you going to scale this?
Yeah, or like a lot of times I've seen a lot of companies lately that have like really large government contracts where it's sort of like,
Ooh, yeah,
not that it's bad. Like I'm not at all
yeah,
discouraging companies. I mean, the government has a very deep pockets. They can be very, they
yeah.
can be a
We're
great
going
customer for a
trillion in
lot of
debt every year
companies.
to buy stuff. So
Exactly. But if you're, if most of your revenue is that, then, it's sort of, those procurement cycles are very
yeah,
long. And it's revenue that oftentimes it's a sales cycle that isn't necessarily repeatable, or to a different type of customer. There might be land and expand within that government agency that you're working with, depending on what it is that you're
yeah.
selling, but it's not something that's going to be, it's not something that shows like broader market demand for what you're doing necessarily. Um, if they're your only customer.
Yeah, I find that at the pre-seed and seed level, that sales risk, that go-to-market risk is so high, and not just about marketing and pricing, packaging, messaging. It's really about the sales motion. Like, how do you scale up a sales motion? So what I've done actually, because we're not a hands-on investor at all with 110 portfolio companies, that's why we call it the Team
I
Ignite.
would hope not.
Yeah, yeah. I'm sitting on 100 boards.
Unless, unless you figured out how to clone yourself,
Yeah,
in which
exactly.
case, can you share that info with me?
How do you
Yeah.
know I'm not a clone? Anyway, maybe someday we'll use AI to clone me and host a podcast. But what
We
I've
will.
done is I've found a few consulting partners that have really had a lot of success. Taking a company that has say 100K of ARR and 5 or 10xing them in 6 to 12 months, and like that, you find the partners that can do that repeatedly, and you plug them in. So you kind of look at something like, oh, this is really talented engineering team. I'll plug in that sales consultant to really 5x that growth.
Totally. Yeah, I think that's a great idea. And that's a great way to be a value add investor. Bringing in whatever resources you need around the table. That's a key part of what we try to do at TVP, especially when we sit on boards. Like, a lot of funds will sit on boards and they'll limit that to just showing up once a quarter to the meeting and, giving a few pieces of advice and then dropping off, and that's that. But we try to be involved all throughout. We want our founders to know that they can always call us, even if it's on a Saturday or, late at night or a holiday.
Yeah,
If they've got something they want to talk through with us, they don't have to wait for the next board meeting. And we want to be able to bring those resources that they need to put those around the table, even if it's not something that's in our wheelhouse
yeah.
necessarily.
Do you guys partner with
So
external
whether that's,
organizations, or is it all in-house, or is it a mix?
we're a really small team.
Yeah,
So we actually don't have a platform team at
yeah. It's
all.
not like A16Z where you got all the in-house people. Yeah,
No. So we don't have any in-house people. It's just our investment team and we have 3 partners, 3 investors, and a CFO, and that's it. But we do have a really deep network of both
right.
other funds that we're able to work with to help companies raise follow-on rounds of capital, which was one of the big areas that they ask us to help provide value. We have lots of service providers we work with, whether it's venture debt providers, which is also a common one, or legal services, or other sorts of consultants, like you mentioned. But yeah, it's all trusted folks through our network. We don't have anyone in
Yeah,
house.
same. I mean, it's why we called it Team Ignite, right? Um, I've toyed with the idea of having everything internally. I feel like you can get best of breed partners outside your organization.
Yeah, it's kind of it's interesting because, like, I don't know, I've seen it go well both ways and also badly both ways. I think for what we do, because every company, we're sector agnostic, so every company we invest in is so different. At Big Idea, we had lots of sort of in-house partners for things like food science and manufacturing and distribution, and things that were like common needs that were pretty universally shared across all the portfolio companies, and that worked well and made a lot of sense. But at TVP, we're sector agnostic, so every company's in a different industry. The needs vary widely. Also, stage wise, we've been around since 2011, so we have some earlier stage Series A companies that are new investments that we made recently, and then we also have public companies in the portfolio. We have Series C, Series D, Series E companies that have been in our
Yeah.
portfolio for a while. So they just have a really wide set of needs. So to have like a marketing or a PR or a fundraising or whatever type of person in house that would be the best person to deliver on the needs of all of those companies that are doing different things at different stages, I think would be tough.
Yeah. And do you work on the growth fund as well? Do you invest from the growth fund or just the A fund?
I'm supporting both funds.
What was kind of the logic of having a separate fund versus just reserving some capital in the A fund?
So we do reserve capital in the A fund for follow-on. The growth fund is not an opportunity fund that just does follow-on investments in our existing portfolio companies. It can, but it's the strategy is primarily net new. So we're going to be doing mostly net new investments. We could do some follow-ons. That'll probably be a small part of the strategy, but the thesis behind that fund is Series B through pre-IPO, small flexible checks for growth stage companies. So $5 to $15 million checks, which is small for growth, and mostly focused on market-driven opportunities. So deals through our network, we're anticipating a lot of down rounds, recaps, restructurings, secondary market transactions, also something we will look at. It's just that the goal is to provide our LPs with 3 to 5x in 3 to 5 years. And that's really it, not have a whole lot of rules beyond that. Because something that we've seen a lot in the market is that some of these larger growth funds have gotten so big that they're, over the course of, raising significantly larger and larger and larger funds over time, they have to write checks of a certain size in order to deploy an amount of capital that's meaningful for them. And in our opinion, that results in deal structures that aren't necessarily in the best interest of the investors or the company. So we want to be able to sort of plug those holes in some of these larger rounds in a way that can provide, alpha for our LPs without being held to any sort of, check size or particular deal structure.
Why don't we switch to the rapid fire? I'll ask you a question. Just give us your immediate thoughts. What's your favorite book?
My favorite book.
One that you would recommend.
Well, the book that I always, one that it's so hard to pick a favorite. One that I always recommend on podcasts like these is called The Four Agreements. It's not a business book. It's more of a life book. But as I said earlier in the conversation, it's all about people. Investing in business really in general, leadership certainly is all about people and how you engage with people. So it's a super short book. You could read it in an hour. And it's essentially 4 different rules to sort of live by of how you interface with others and with yourself and with the world. And it's been super helpful for me in my growth as a person.
I've heard of it, but I don't think I've read it. What are the 4 agreements? Do you know them off the top of your head? Or let's look them up.
I will pull them up right now.
I got it. Be impeccable with your word. Don't take anything personally. Don't make assumptions, and to always do your best.
Yes.
I love that.
But now you're going to reveal to all your listeners that I didn't know them off the top of my head.
I'll cut it out. I'm terrible. My memory is like, I'm in my 40s now. My memory is just like fading. I could just feel it fading. Like it's really sad.
I know. There's too much. It's because we constantly bombard ourselves so much with too much information. I feel like my brain is just constantly in a state of information overload.
Bombarded with information. I'm looking at 10 or 15 decks a day. And I meet, probably 5 to 10 people a day, and I'll get on calls. I'm like, with a founder, and we had a call 6 months ago, and I totally forgot. I'm like, hey, nice to meet you. Like, hey, we met.
Oh my god! And people's names are the worst. People like don't even get me started. I'm so bad. I'm constantly embarrassed. Every happy hour I go to, it's like I know you, and I have no idea what your name is. Yeah.
I'm the same, and I find myself since I became a full-time VC, I'll go to social events and I don't want to talk to anybody.
No, yeah.
You know what I'm talking about? Like, I'm just I don't even want to go to any events, and I don't want to talk to anybody because that's my job. That's all I do all day. And I love talking to people. I love doing. That's why I do the podcast. I love meeting interesting people. But there's something about like, if you go to an event, you can't control it. You end up just talking to people, and it may not be the most interesting person to talk to. But there's something about like, when I control my calendar and who I talk to, I know it's an interesting person because I decided to talk to them. You know what I'm
Totally,
talking about?
100%.
Yeah.
I know exactly what you're talking about. I've gotten very, very, very picky over the last couple of years with events.
Yeah.
Because are you in New York or are
No,
you
I'm
in
in
San
California.
Francisco?
I'm like halfway to
You're in
Tahoe from the
California.
Bay. Yeah.
Oh, nice. I'm not sure what it's like out there, but at least here in New York, I mean, you could go out drinking for free every single night of the
Oh,
week and
easily.
call it work if you're a VC.
Oh, yeah.
And it's just very easy to fall, especially as a Series A investor. I think pre-seed and seed maybe it makes a little bit more sense, but like especially Series A, like if you're going to just like a big general New York tech
Yeah.
happy hour, that's not really where like the quality founders at Series A and up are hanging out necessarily.
No, they're working on their startup.
Like
They're either at the gym,
right,
hanging out with their family, or working on their startup. And yeah, you're not going to
exactly,
find them at a happy hour.
right. And so happy hours are mostly useful for like meeting other VCs, which is good and is useful. And I honestly like the best deals that I've gotten over time have been through referral,
100%.
you know, like someone in my network.
Yep.
So it's great to maintain those relationships, but I've started really limiting my event attendance to either events where I have a role of some
Yeah.
sort, like I'm speaking
Or
or I'm
I'm judging a pitch
organizing it or
competition or
something.
something. Yeah.
Yeah, or somewhere where I know the organizer, and so I know that like it's going to be curated, and I'm not going to be bombarded with like a million like idea stage
Yeah. Oh, man.
founders
That's
I'm trying not. I don't want to be
we're
rude, but
the
like I
stereotypical
just
VC. I remember like back in
I know.
business school, like just talking to VCs. I'm like, you guys are just an irascible, standoffish kind of bunch, aren't you? And now I know why.
Yeah, it's because we say no professionally.
Yeah.
We're professionals at saying no to
99.9% of the time,
people.
we're going to say no, including to our friends, which
Yeah,
really
it's
sucks.
yeah, yeah. We are literally professional. We're literally professional naysayers while simultaneously operating in what theoretically is like supposed to be the most optimistic class of investment,
Oh, we're definitely
which is like an
optimists.
odd.
Yeah, I'm a total optimist, techno optimist. I feel like the future is going to be amazing. Like that's the hardest part of the job. Actually, is I'm such an optimist that I believe everything could work. It's just a matter of when and what team, right? Um,
Right.
and so like I have to, you know, there's like easy yeses in this industry where you just meet somebody who's like everything clicks here. But there's lots of easy no's as well. Anyway, what's your morning routine?
Morning routine. Well, I get up, I push snooze a bunch of times, and then I feed my cat, who's always very vocal at that part of the day. And then I do yoga. I do a little physical therapy routine. I've been through a lot with my lower back this
Oof.
year, and some meditation, get in like that mindful headspace for the day
Nice.
ahead. Take a boiling hot shower.
Oof.
Everyone else I know swears by the ice bath. I swear by the lobster boil. It does wonders for my mental health, really helps reduce my anxiety. It's great. Would highly recommend. Then get ready, go to work. Lots of coffee.
Yeah, I like the contrast, you know, the hot tub to the cold plunge. So here in California in the winter, the pool is, you know, icy, 48 degrees. So we'll heat up the hot tub and then jump in the pool. And that's so amazing.
Totally. I'm not a morning person, if you can't tell. Mornings
neither
are
am I.
painful.
I'm a night owl. Like,
Yeah.
I come alive at about
Me too.
9 o'clock at night. I'm like, let's go.
Same. I get my best work. Yeah. My best work is done from the hours of 8 p.m. to 2 a.m. for sure.
Yeah.
That's just like when my brain is in the zone.
Yeah, I could burn it all night. Anti-portfolio question. What's your which startup, past or present, do you wish you invested in?
This is like one like any startup at all from the past, like any company at all from the past. That I've looked at, or any company in general?
Let's break it into two parts. Let's explore when you passed on. You're like, ooh, I shouldn't have passed on that. And then historically, if you could go back and invest in any startup, which one would it be?
There was a really interesting company that was making, back in my time at Big Idea, that was making mycelium-based scaffolds for cultivated meat. And I thought that what they were doing was super interesting, and we just couldn't get to conviction around the market for that product, just because we couldn't get to conviction around the fact that like the cultivated meat producers were going to buy the scaffolds from an external outside party instead of making them internally themselves. But now sort of seeing how that growth in the industry has evolved over time, and then also some of the other use cases for those types of products, I think maybe that would have been a good one to invest in. But yeah, maybe we cut that one out because I'm blanking on the name of it.
I had a consumer to consumer company. I'll be very careful about saying anything in particular because I might be able to get back in the round now. But when I looked at it, it was like, I don't think this is going to work. And just getting consumers to do this thing and that, and now they have 4 million of ARR. Like, ooh,
totally.
Yeah, my instincts on consumers are so bad.
Yeah, I don't know. Consumer's a tough one because like also it's very fickle, right? So like there's another company. Maybe this is a better one to talk about for the anti-portfolio actually, because it's more recent and it's from TVP. But they were, I'll keep the name confidential, but they were a consumer app focused on women's health. So they were specifically looking at pelvic floor dysfunction. And they were, it was a huge problem that like I didn't know existed because I'd never been pregnant, but apparently for women who had been pregnant or were pregnant or had recently given birth, it's this really common condition. We passed because we couldn't get comfortable with the level of stickiness of usage. So consumers would use the app and they would have a great.
You solve the problem, and now you don't need to pay for the app anymore.
Solve the problem exactly. It would solve the problem, and then they wouldn't necessarily come back.
It's also a shrinking market, right? Because less people are having kids over time.
Yeah, well, that's going to cause problems for us for lots of other reasons.
Yeah, that's a whole nother podcast.
That was a really interesting one. Yeah, exactly. More macro focus, but we passed on them. And I remember I did a lot of diligence. We passed on them in early 2022. Now, they've had really strong growth, kind of a similar thing. They have a lot of like enterprise consumer partnerships. And they actually ended up doing it all without really raising a lot of venture funding, which was really impressive. That just sort of goes to show that like with consumer stuff, like it is really sort of fickle. And also with that 4 million ARR growth, who knows how sticky that is.
Who's going to pay $15 a month to have somebody talk to them about meditation?
Lots of people
apparently. But like who would have guessed?
Even though you can get it all for free on YouTube, so there really isn't a reason to pay $15 a month. But lots of people are doing it. Calm and Headspace have millions of users.
What's your go-to meditative technique?
I'm doing Ram Dass's meditations recently, which I really like. They're more about like grounding in the present moment, which I really like. They're just sort of focused on seeing the world, feeling the world around you, like feeling the ground beneath your feet and hearing, sounds and noticing things in your environment without judgment or attachment, which is really helpful. And the nice thing about it is that it can be done anywhere for any length of time, like even for a brief moment. Even if you just have 15 seconds in between meetings, and you just notice the presence of your feet on the floor and, listen to
it's insight meditation. It's like, oh, there's a bird, Interesting.
Yeah. It's more just about grounding yourself in the present moment. Cause I know for me, I have a mind that's always going a million miles per hour and thinking about 12 things at once. And to the point where sometimes it can be very easy to be out of your body and out of your brain completely. So having that like tactic of grounding down into the present of what you're feeling is great.
Yeah, I love that. I've done a bunch of meditative practices over the years, including in New York. When I lived there, I was in a Tibetan Buddhist meditation program. And
cool.
Doing the Lam Rim, which is like a cycle of 21. I've done the 10-day silent Vipassana.
You
Yeah, it's
have? Oh my
super
God,
hard.
that's come highly
Ooh,
recommended to me by a number of
yeah.
people. I don't think I could handle it.
I
I
can't
really
recommend
don't.
it, honestly. It's so hard. And I spent like 3 days crying out of 10. The one I wish I would
Wow.
have found 20 years ago is transcendental meditation, which is really simple. They just give you a mantra to say, and it's just the best. Yeah.
Interesting. Have you ever done any breath work?
Yeah, my wife's a
I
teacher,
love,
actually.
oh
Yeah, my
really?
wife's a
Oh,
certified
cool.
breathwork instructor. So yeah, I've done
That's fun.
it.
I've been doing a lot of holotropic breath work recently. That's really nice. That very much. I was amazed the first time I did it. Like I cried the
Oh
whole. I
yeah.
cried for like an hour at
Yeah,
the
just
end. Like it
releasing the
really
stress.
does release.
Yeah.
It gets to the root of whatever it is you're going through. Like I wasn't expecting it to be. I was expecting it to be therapeutic, like in the same way that like meditation is therapeutic. I
Yeah.
wasn't expecting it to go so deep and really unearth things
Yeah, yeah, we have
in that
lots of
way.
bound karma deep inside us, right? From at least this life,
Yeah.
if not past lives, if you believe in that kind of thing. And
That's another episode
that's
too.
another podcast episode. But I'm actually going to have somebody from the TM organization on who taught Ray Dalio and Bridgewater, and yeah,
Oh,
so Oprah, her whole company does TM, and the Beatles did TM
nice.
with the Maharishi and all that stuff.
Cool.
But yeah,
I went to, oh, sorry, go
no,
ahead.
no. The last point I was gonna say that TM also is similar to breath work in that it kind of just it releases all that stress and you cry, and so yeah, very frequently in meditation, the 20 minutes twice a day.
Yeah. I went to this place for a while on the Upper East Side in New York called the School of Practical Philosophy,
Oh,
um,
I
which
remember
was
that.
super
Yeah, yeah.
cool.
I never went there, but I've heard
Yeah,
of it. Yeah.
it was really great. I stopped going. I felt like I sort of got the maximum I could have got out of it after going for a couple of years and stopped going. But it was really, really amazing. I mean, I had zero yoga or meditation practice. Like, never thought any of that stuff was for me at all before I started going there. And I was in a not great mental place, and I saw an ad on the subway, and I went, and it was really awesome. Like for anyone who's sort of a beginner and just like, is sort of averse to
Yeah,
maybe some of those ideas, I definitely recommend it as a starting point. And they have online classes too.
that's super cool. Is it like Stoic philosophy that they teach, or is it kind of
No, it's more like it's Vedic philosophy.
okay?
So it's
Yeah,
it's it's still like, like ancient Indian in traditions. It's more the sort of be here now
right,
philosophy.
like the
So
Ram
like,
Dass kind of stuff.
grounding
Yeah.
down. Yeah, like grounding down into the present moment, and but they teach a lot of other like interesting concepts, like different levels of the soul, and like,
Hmm.
different ways of feeling, whether something's coming from your heart or from your gut or from your soul, like
I like that.
in
Yeah.
introductions to a lot of like those kinds of concepts, which is
Yeah,
cool.
TM is from the Vedic tradition. So Maharishi
Oh,
was, yeah,
cool.
from that whole school. Anyway,
Nice.
I feel like I could talk to you for
All
another
related.
2 hours. This has been the longest podcast I've actually recorded. I've never gone over an hour. So thanks for hanging out a little longer.
Oh, of
This is a,
course.
yeah,
Yeah.
fantastic. I had a fantastic time. Thank you so much.
It was a pleasure. Thank you so much for having me.
Thanks, Abby.